If you invest in tax-free bonds, you're most likely looking to generate the maximum amount of income that you can while maintaining good credit quality. I'm Glen Rosenberg, and we're going to talk about one great way that you can accomplish that. It's by using non-rated insured municipal bonds. If I were to offer you two different bonds, Bond A and Bond B, if both bonds have the same exact credit quality and both bonds have the same exact length of maturity, except that Bond A was offering 4.5% and Bond B was offering 5.5%, which bond would you choose? Now, this isn't a trick question. The answer should be Bond B. Now, what if you knew that Bond A over here had an A+ rating, and Bond B, which again has the same exact credit quality, in fact the same backing, the same revenue stream, Bond B simply didn't have a rating? Would you still choose Bond B? If you're not sure of the answer to that question, then it's a good thing that you're watching this video. We're going to talk about first, how did non-rated bonds come about? Well, oftentimes bonds are issued in the following way. A municipality will issue a bond, and this box here represents the bond issue itself, and that bond guarantees the timely, that's very important, the timely payment of both principal and interest. And many times those bonds are issued with a wrapper of insurance. That's what this outer box represents. It's a backup plan, so to speak, where this insurance plan guarantees the timely payment of principal and interest if the bond issue is unable to do so for whatever reason. Now, for many years, these municipal bond insurance companies were AAA rated. While a few years ago, these municipal bond insurance companies lost their AAA ratings. When that happened, it left many bonds insured but non-rated. Now, despite the fact that they no longer have a rating, many of these bonds actually have very high quality credit characteristics, and informed investors actually seek out these types of bonds because they offer substantially more income while maintaining good credit quality, which is what most bond buyers are looking for. How much more income? Well, this right here is probably a pretty good estimate of what you'll find. On two different versions of the same bond, one having a rating and one not having a rating, the one that doesn't have a rating can offer up to an additional 1% income. Now, what does that actually equate to in dollars? Well, on a $1 million portfolio, that adds up to an extra $10,000 per year. Multiplied by 10 years, that would equate to an additional $100,000 of additional portfolio value at the end of the 10 years, not including compounded interest. And this is based on $1 million. You might want to look at it based on $2, $5, or $20 million, and you might want to look at it based on 20 or 30 years. The point is that this number, the opportunity that non-rated bonds offer you, only gets larger and larger and actually grows into the millions. This right here should be your motivation for wanting to understand non-rated bonds and actually incorporate them into your portfolio. Let's go over a couple of key points that I feel are very relevant for you to understand about non-rated bonds. First, non-rated or not having a rating doesn't mean high credit quality, and just the same, it doesn't mean low credit quality. It simply means it doesn't have a rating. That's all that it means. Now, the second part is that these bond insurance companies, oftentimes, in fact, almost all of them lost their ratings as a consequence not of exposure to municipal bond debt, but as a result of exposure to mortgage-backed securities and the real estate collapse that occurred a few years ago. Now, the third point is that when a lot of these municipal bonds were originally issued, there was no need for them to apply for an underlying rating, since when they came out with insurance wrapped around them, they automatically inherited the rating of the insurance company, which many times was AAA. So there was no need for them to apply for a rating. In fact, it was an unnecessary expense to apply for and ultimately pay for an S&P, Moody's, or Fitch rating on the issue itself. That's the difference between an underlying rating and an insurance rating. Very important, that distinction. Now, the fourth point is that these municipal bond insurance companies don't insure bonds that they don't believe are going to pay. Or in other words, simply put, they only insure bonds that they believe, and in fact they are convinced, are going to pay. Let's use common sense here for a moment. Imagine you're the municipal bond insurance company. If you're considering insuring a bond, you're only going to do so if you're convinced that that company is going to pay. Because not company, but municipality. Because if that municipality doesn't pay, you are on the hook to make those timely payments for them. So this should give us a lot of confidence as investors that if a bond is insured, whether it's rated or if it isn't rated, either way, we know it went through a very rigorous underwriting process, and an insurance company was convinced that this bond is high quality and it's going to pay. Now, the fifth and last point is that as individual investors, we're very well positioned to take advantage of these types of bonds. Why? Because a large segment of the institutional buyers out there are unable to buy these types of bonds because ratings criteria is a part of their investment policy. Now, that's non-rated insured bonds. It's an amazing way to increase your income, maintain good credit quality, but it's very important when you're going to buy or even consider buying these types of bonds that you're in touch with the proper guidance, that you have professionals and expertise in this area that's guiding you, and that they offer the research that can help you to analyze the credit quality. Because if there is no research, there's certainly no S&P or Moody's report because they're non-rated. That's the point. Okay, so it's very, very important to have the proper guidance in this area. So I hope this was helpful for you. I'm Glen Rosenberg, and you just learned about non-rated insured bonds. Catch you on the next one.